Hello, everyone. How's everyone doing today? Good. The seminar you're about to see today is a pretty special seminar that we've been doing at our firm for the last few years. This is the only seminar we do where we talk about a specific investment recommendation. All the other seminars we do are concepts and strategy. We have a growth and income bucket seminar that if you haven't seen yet, you need to see it. That seminar represents the cornerstone of our firm. Over 90% of our clients use that strategy. If you haven't been to that seminar yet, you need to see it. We do some tax planning seminars, estate planning seminars, college savings seminars, concept, informational type stuff. This seminar is the only seminar we do where we talk about a very specific asset allocation. Is anyone in this room frustrated with how low interest rates are these days? Good. What's nice about being in a CD? Some safety, right? And if you could get a 4 or 5% interest rate, it's a pretty good deal, right? We created this allocation called Tactical Income Solution to kind of fill the gap between a CD and a more aggressive investment. Now, please understand, what you're about to see here is not a CD replacement. This is an investment, and there's a big difference between a CD and an investment. We're going to talk about that here soon. But I just want you to experience this seminar, see what this allocation is all about. I think you'll find it meets a lot of your needs. It's a conservative, safe allocation. It's well-rounded. It's backed by some very good logic, has a fantastic dividend, and will provide you with a reasonable return over a reasonable period of time. Tactical Income Solution. Before we get into that, let me tell you a little bit about myself and the firm. So my name is Benjamin Paul. I'm a financial advisor with the Trinell Financial Group. I've been at this firm for 10 years. Just have my 10-year anniversary this month. Started January of 2005. I serve on the Liberty One Investment Committee. That's the investment committee responsible for putting this Tactical Income Solution together. And that's also the committee that manages the Tactical Income Solution on an ongoing basis. Very neat stuff. The Trinell Financial Group is comprehensive financial planning. The seminar you're going to see tonight, like I just mentioned, is about a specific investment allocation. But we do far more than just invest clients' money. We are full-service, comprehensive financial planners. We do tax planning, estate planning, insurance planning, cash flow planning, risk management, RMD planning, IRA rollovers, you name it, we can do it. So just because we're talking about a specific investment today, I don't want you to limit your thoughts into what we're able to accomplish. Our mission when doing this comprehensive financial planning is to help our clients enjoy a better life. That's at the core of what we do. That's what we talk about every single Monday morning meeting when our whole staff gets together. We help our clients enjoy a better life. There is a lot of jargon in this industry, in finance in general. A lot of fancy words, a lot of terminology that the general public doesn't really understand. I get that. Financial planning is grounded in the numbers, but it's so much more than the numbers. Is it fair to say that when it comes to finance, the general public, you guys don't know what you don't know about finance, right? I think you all probably fall in that boat. That's why you're here tonight, to gain more information. It's our job as financial advisors to take what we know, take all the knowledge that's up here, take all the experience that we have, and use all of that in a way that will give you clarity and confidence about your future. It's not about the jargon we know. It's not about the fancy numbers we can throw on a spreadsheet to try and wow you with fancy returns. At the end of the day, it's what that money means to you and how it will affect your life, and ultimately the clarity and the confidence it gives you to live life the way you want to live it. That is at the core of what we do. That's our mission. We carry out our mission at 1509 North Milwaukee Avenue, the building you're sitting in right now. We have a fantastic team of professionals here. We have 26 employees. During the summer, we have what we call the Taste of Life program. That's a program where we bring college interns into our company. Some of them work 5 days a week, all summer long. Some of them work a couple days a week here and there. We'll usually have 6 to 8 interns basically on the schedule at any point in time during the summer. So not only do we have a very professional 26-person staff that's able to give you this comprehensive financial planning, we also have a team of interns that we're dedicated to as professionals to bring them up in this industry and teach them what we know. It's a very neat company to be a part of. Collectively, we manage about $300 million. $150 million of that is through our financial institution relationships who contract with us. Great Lakes Credit Union, Itasca Bank, and National Bank and Trust are the 3 institutions currently contracted with us. I personally am in charge of the Great Lakes Credit Union relationship. I know some of you in this room today are here because of the Great Lakes Credit Union relationship that we have, and that's fantastic. As I mentioned, comprehensive financial planning is far more than just investment management. Everything from estate planning, rollovers, thrift savings plans, accounting and taxes, insurance, long-term care, all those things that I already mentioned. The best part about working here is we can offer all these services on a completely independent basis. If I was a Fidelity advisor and you came to my Fidelity office, chances are I'd have a bunch of Fidelity mutual funds that I'd propose to you. If I was a Vanguard rep and you came to my Vanguard office, I'd have a bunch of Vanguard funds. If I was a Prudential rep and you came to my Prudential office, I'd have a bunch of Prudential insurance products to sell you. The beauty about this organization, the beauty about being licensed through Money Concepts, is that we are completely independent. Raise your hand if you've ever heard of Money Concepts before. A couple of you. Okay, and that's normal. You guys are actually my current clients. That's why you heard of it. Okay? The majority of the room has never heard of Money Concepts before. That's because Money Concepts allows its representatives to self-brand who they are. We are the Trinell Financial Group. We are licensed and we clear the buying and selling of our investments through Money Concepts. Through Money Concepts, we can buy any stock, bond, mutual fund, annuity, REIT, or insurance policy you can think of. Pretty neat stuff. Once you become a client with all these independent choices that we have, we implement what we call the Faithful Watch program. It's a program that we take all of our clients through. How many of you currently work with a financial advisor? Quick show of hands. Okay. Is it fair to say that some of you in this room probably haven't heard from your financial advisor in a while? Is it fair to say that's probably why you're here right now? Because if you had a great relationship with your financial advisor, you'd be talking to him or her about these concepts. You wouldn't be coming to this seminar sponsored by the Trinell Financial Group. So you're here for a reason, because you need some information. You want some knowledge, and some of you are probably kind of shopping around looking for a good firm to partner with for your own personal finances. The Faithful Watch process is our ongoing account review process that we do with all of our clients. We meet with our clients on a semi-annual basis, and when you come in to talk to us, we're not just talking to you about your investment accounts. Everything we talked about on this slide and the previous slide, tax planning, estate planning, risk management, cash flow, everything is covered in these meetings. Again, comprehensive. That's what we're here to do. And ultimately, like I said, we want all of you to enjoy a better life, giving you clarity and confidence about your future. Now, if you would please, in your folders in front of you, you've got an evaluation form. If you open it up, it's on the left side towards the top. You don't have to fill this out right now, but I just want to make you aware of something. Okay? Now, listen to what I'm going to say, because this is important. I really mean this. I say this at all my seminars. On that form, you'll see, ask for your name, your address, your phone number, and then it asks for a critique of the seminar. Can anyone guess why we do these seminars? Any ideas? Get clients, that's right. We are doing this seminar for you because it's an easy way for all of you to meet us. It is very intimidating walking into a financial advisor's office, not really knowing that person too well. You don't know what they're all about. You don't know what their concepts and their strategies are like. You don't know what their personality is like. It's intimidating, especially when you're talking about something as personal and as confidential as your money. So these seminars are a great way for us to engage the public, and it's a great way for you to come into an environment where there's a lot of people. You're not singled out sitting across the table from an advisor. It's a great way for you to kind of size us up and see what we're all about. And like I mentioned, our goal is for what you're about to see here to be so powerful and so compelling to your financial well-being that you want to schedule a time to get together and meet with us. Here's what I want you to remember when we circle back to the evaluation form at the end of the seminar. At the end of the seminar, I'm going to ask you to either put your phone number down or not put your phone number down. I know that sounds weird. I only want you to put your phone number down if you want me to call you to follow up after the appointment. Now, I know what some of you are thinking. Some of you are thinking, I'm not going to put my phone number down because I'm just going to call him. I don't want him calling me. I know that if you really want to get together, put your phone number down. If you don't put the phone number down, I won't call you. But I also know, even if you want to meet with me, chances are you'll never call me. Because it all sounds great right now, but tomorrow you'll wake up and you'll be busy. And then you'll say, I'll call next week, or I'll call 3 weeks from now, and before you know it, 3 years just went by, and you still haven't sat down to talk to a financial advisor. So please do yourself a favor. If you like what you see here today, write your phone number down, and I will follow up with you. If you don't write it down, I won't hound you. That's not what these seminars are all about. Give it an honest look, and we'd love to meet with you if you feel comfortable, okay? We'll circle back to this at the end of the presentation. Tactical income solution. The agenda for today is to talk about these 4 key areas. I'm going to talk a little bit about what we do. I'm going to talk a little bit about what we call the global growth story. We're going to talk about dividends and how they're not all created equal. And we're going to close with tactical income solution, the allocation that's going to weave all this together. So first, what we do. We help people accumulate money more efficiently. We help people produce income produce greater income from their portfolios. And ultimately, we help our clients transfer their money onto loved ones. Today's seminar is going to focus a lot on the first 2 points. Grow money more efficiently and create income from your money. Tactical income solution. Naturally, it better have something to do with income. And what's interesting about this portfolio is there's actually a really neat estate planning twist that we can put inside this account to make it very tax efficient to pass on to your loved ones. I'm going to touch on that just a little bit, but the core is about accumulating money efficiently and creating income from your portfolio. When I sit down with clients for the very first time, we have what we call a discovery meeting. It's a chance for us to get to know each other. I want to learn who you are. I want to learn where you're at. I want to learn where you want to be, what your goals are. It's my job as a comprehensive financial planner to figure out how to get you there. Okay? When I sit down and talk to someone for the very first time, we have some very revealing conversations. And when it comes to retirement planning, these questions, these emotions almost always come up in that discovery meeting. Number 1, will I run out of money? Is it fair to say that everyone in this room wants to make sure their money lasts as long as they do? Of course. You don't want to run out of money. That is a very legitimate concern and a fear that all retirees have as they enter retirement and even through retirement. You don't want to outlive your money. Second, we all want to maximize our potential. That's a neat one. Maximizing your potential means that it would be a shame to work somewhere for 5, 10, 15, 40 years, work somewhere for 40 years, save diligently over that time, and not get everything out of that savings that you want to get out of it. Most of us in this room probably have a bucket list. Things we want to do, places we want to go, people we want to spend time with. Chances are it takes money to do those things. It would be a shame to not be able to do those things that you want to do, to not maximize the enjoyment of your retirement. That's on people's minds. They want to make sure that they can do the things they want to do. Visit the grandkids, take a couple vacations every year, buy a motor home, buy a boat, whatever that thing is. Okay? And third, and this is more relevant now than ever, it really became relevant in 08 and 09, is people don't want to be so worried about their finances that they can't enjoy their retirement. There's a lot of emotion tied to money. Accounts fluctuate, they go up and down. Is it fair to say that the pain of losing money is twice as strong as the joy of making that same amount? If you lost $10,000, that would really hurt. If you made $10,000, yeah, you'd be excited. That's a good day. But the pain of losing that same amount is twice as strong as the joy of making that amount. There's a lot of emotion tied to money. So these are real concerns and questions that people have when I first meet with them. These questions and concerns are why you're here tonight. Like I said, it's not about the jargon, it's not about the technical expertise, it's not about me being able to talk you to sleep on these topics. Believe me, I can talk anyone in this room to sleep on any financial topic you want to pick. I'll knock you right out. Okay? It's not about that stuff. It's how I use the knowledge of that stuff to help you enjoy a better life so you can be clear and confident about the answers to all these questions. That's what we do. Into the meat of the presentation, the foundation for the tactical income solution. This solution is grounded in what we call the global growth story. Imagine coming to my office and I put this slide up on the wall. And I ask you, hey, you want to invest in that? What would you say? You'd say, yeah. But you'd also say, what the heck is it? Anyone take any guesses? What if I told you the measurement of this thing dated all the way back to the year 1790, and I'm showing projections that go up to the year 2050? Any guesses yet? What if I told you it was measured in millions? This is the historical and projected growth of the U.S. population. Population of the U.S. has never gone down since they started counting. It always goes up. Where population lands in this world is pretty neat. Of course, all the coastal areas, all the spots in China and India and Central Europe that you'd expect population to be. Not only is U.S. population growing, world population continues to grow year after year after year. Wouldn't it be nice if you could invest in population growth? You'd never have a down day. In fact, every day on this planet, there are about 190,000 more people than there was the day before. The birth rate trumps the death rate by about 190,000. Every single day, 365 days a year. All these people need somewhere to eat, shop, work, play, and live. So you can't directly invest, you can't directly buy population growth, but you can invest in it. You just need to be a little creative. Let me tell you a story about McDonald's. So I had a couple meetings here one day. This was back in 2009, early 2009, really the depths of the financial crisis we went through in 08 and 09. I had my schedule was booked pretty tight. I had an 11 o'clock meeting and I had a 1 o'clock meeting, and I had an hour in between for lunch. My 11 o'clock meeting ran long. Went till about 12:30, had a half an hour, needed to grab some lunch. There's a McDonald's right down the street. I'm kind of in a hurry. I get to that McDonald's. I walk in, and I'm a little deflated, a little defeated at that point. Because I walk in, and there's 5 registers, and each register has 4, 5, 6 people in each line. Remember, it's 12:30, so it's peak lunch hour. I get there, and I'm in a hurry because I got to get back by 1, and I kind of jokingly say to myself, I guess there's no recession at McDonald's. Okay? And that's where this concept started. And I thought to myself, that's interesting. Here we are, spring of 2009, the depths of the worst financial crisis since the Depression, and McDonald's is stacked 5 across and 5 or 6 deep. I thought to myself, that's interesting. No matter what's going on in the economy, people still eat at McDonald's. McDonald's is what we call recession resistant. McDonald's is one of the corporations that we're going to recommend you invest in inside this portfolio. McDonald's makes the cut for this portfolio because regardless of the state of the economy, people still eat at McDonald's. The demand for McDonald's continues to be fueled by population growth, and they pay a strong and consistent dividend. I live up in Salem, Wisconsin. Up in Salem, there's an intersection. Highway 50 meets Highway 83. It's called Brass Ball Corner. In that intersection is a BP/McDonald's. All around there is cornfield. There's some homes there, but it's a lot of cornfield. There's plenty of development opportunity. As population gets bigger and those cornfields get developed, does that mean good things for that McDonald's location? Of course. Because all these people, like I said, need somewhere to eat, work, shop, play, and live. Eat at McDonald's. Regardless of the state of the economy, people still eat there. Okay? Pays a great dividend, fueled by population growth. Population growth is the catalyst behind the growth over time. The strategy is ultimately suitable, and I use this verbiage with all my current clients, suitable for investors seeking a reasonable return over a reasonable period of time, and they want to collect an attractive dividend stream along the way. That's a very important sentence, a reasonable return over a reasonable period of time. I will be the first to tell you, you will not hit a home run in terms of return with this portfolio. You won't. It is designed to give you a reasonable return. Our goal with this portfolio is to keep the fluctuation very low, the return reasonable, and the dividend high. We're going to talk about that here a little more in a second. Some clients tell me, well, Ben, the S&P 500 was up 30% in 2012. Pick a year. Why did my portfolio go up that high? Because I tell them, if you want all the upside, what else do you have to be willing to accept? All the downside. Okay? Everyone wants all the upside. Nobody wants any of the downside. I tell them, you're not being reasonable. This portfolio will give you a reasonable return over a reasonable period of time while collecting a very attractive dividend stream along the way. Okay? You're really going to like what you see here. So let's talk about dividends. Not all dividends are created equal. Before we get into different types of dividends, I want to make sure that we all have a pretty good understanding of what a dividend is. A dividend is a way that corporations, not all of them, but some of them, it's a way that corporations share their profits with their share owners on a regular basis, usually quarterly. So if I'm McDonald's and I'm making a lot of money selling a lot of cheeseburgers, I can choose, if I want, to send some dividends, some of those profits, to my share owners every quarter, just to hold the stock. You get those dividends. I'm sure some of you in this room own some Abbott, and probably some AbbVie stock. Is that right? Yep. And what do both those companies do like clockwork every quarter? They send you a dividend. Dividend is really just profit sharing. It's a way for a corporation to share its profits with you. Am I explaining that okay? Good. Let's break down the dividends a bit. Let's look at Johnson & Johnson. Johnson & Johnson is another one of those companies that really fit the bill for this portfolio. Regardless of the state of the economy, people are still going to buy Band-Aids and Windex and Shout and Pledge, you name it. I buy a lot of the Johnson & Johnson baby shampoo right now at my house, right? No matter what's going on in the economy, people still buy those things. Recession resistant, pays a nice dividend, okay? As of December 26th, 2014, Johnson & Johnson was trading at a share price of $105.06. At that moment in time, they had declared a $2.80 per year dividend. So for every share you own, Johnson & Johnson will send you $2.80, no matter what the stock price is worth. Keeps coming out like clockwork. That yield, when you take the dividend in terms of dollars and divide it into the yield, into the share price, that represents a 2.7% dividend. That's the yield that Johnson & Johnson is going to pay. What's unique about Johnson & Johnson is they are what's known as a dividend aristocrat. So not only do they pay their dividend quarter after quarter and year after year like clockwork, they increase their dividend every single year like clockwork. In fact, to be a dividend aristocrat, it means that you've never not raised your dividend, meaning you've raised it every year for the last 25 years like clockwork. Wouldn't it be nice if you owned an investment, an allocation, where every single year you were getting more income than you were the day before? Wouldn't that be nice for retirement planning when it comes to inflation and income planning? Take a look at the dividend history for Johnson & Johnson. In 1997, Johnson & Johnson was paying its shareholders 43 cents a share. Today, they're at $2.80, six-fold since 1997. Raise your hand if your income through your employment is up six-fold in that period of time. It's laughable, right? It's crazy. But with this portfolio, it happened. And it will keep happening, I'm confident, for decades to come. Because no matter what's going on in the economy, people still buy products from Johnson & Johnson. And is it fair to say that those products are fueled by population growth? Because everyone needs them all the time. Talk about AT&T. AT&T on December 26th was trading at $34.17 a share. They pay $1.88 a share in dividends. I share this with you, benchmarked against Johnson & Johnson, because some people will look at this and say, oh, they're paying a lot less than Johnson & Johnson. Johnson & Johnson's at $2.80. AT&T is at $1.88. I want to buy more Johnson & Johnson. AT&T is paying more because they're yielding more. If you took $10,000 and invested it in Johnson & Johnson, you would get $270 worth of dividends, 2.7%. Because Johnson & Johnson's shares are expensive relative, the yield you get is lower. AT&T at $1.88 a share and a much lower share price, if you put $10,000 into AT&T, you would receive $555 of dividends. It's not about the dollars per share, it's about the yield. When we blend all these different holdings together, it makes for a very attractive yield. We'll be talking about that more in a second. Look at AT&T's dividend history. That's impressive. This history is going back all the way to 1985, and believe me, it could go back further if we wanted it to. Back here, they were at about 50 cents a share, and here they are over $1.80 a share. Again, like clockwork. It doesn't matter about the crash in the 80s, the crash in the 90s, 9/11, the 2008, 2009 financial crash. None of that stuff affected the dividend. In retirement, it's all about cash flow, right? Having enough cash flow every month to live your life. the way you want to live it. If your cash flow is always going to be there, and not only is it always going to be there, but it's always going to go up, how can that not work for you in retirement? It's a beautiful thing. I know I've shown this slide a couple times already, but it's important. It's the foundation for what this allocation is all about. Regardless, let's say the economy, people are still going to pay their cell phone bill, AT&T. They're still going to pay their electric bill. Whatever prescription drugs they're taking, they're going to continue to take. Johnson & Johnson. Okay? Pays a nice dividend, fueled by growth. I mentioned in this section that not all dividends are created equal. This is what I mean by that. On the screen behind me, you'll see all sorts of companies with their dividend yield right next to them. Some of these yields are actually pretty attractive. Mattel, the toy company, has about a 5% yield. Ford Motor Company has about a 3.25% yield. Pretty nice dividend. None of these make the cut when it comes to this portfolio. Why is that? Because regardless of the state of the economy, people aren't buying new cars. Regardless of the state of the economy, people aren't traveling to Disney World. Regardless of the state of the economy, people aren't remodeling their bathrooms and giving Home Depot business. Now, could I make an argument that every company on this list benefits from population growth? Of course they do. They all do. They all benefit from population growth. They all pay an attractive dividend, but they are not recession resistant. They don't make the cut for that reason. So let's talk about what does make the cut. You may have heard a phrase before, and if you haven't heard it before, I'm definitely going to explain it to you. Non-cyclical. The opposite of non-cyclical is, of course, cyclical. There are certain sectors, certain companies in this country that cycle through good times and bad times as the economy cycles through good times and bad times. Ford Motor Company is a perfect example. Very cyclical. When the economy is great, people are buying new cars. When it's not great, people aren't. It cycles. Demand for the products cycle. Non-cyclical products don't cycle. We'll talk about some examples here in a second. Traditionally, if you look up non-cyclical in the dictionary, it will talk about consumer staples and it will talk about utility companies. Those are traditionally the only two sectors that fall into non-cyclical. Okay? But remember, we're not building a non-cyclical portfolio. We're building a recession-resistant portfolio. And there's a difference. I'm going to show you this difference right now. When it comes to non-cyclical, a lot of the naysayers will say, time out. The biggest criticism against the non-cyclical portfolio is that it underperforms when times are good. So when the market's up 30%, will a defensive non-cyclical portfolio be up 30%? No. We already talked about that. It's designed to give you a reasonable return over a reasonable period of time. It's not designed to beat or do what the market does. But what I love about this criticism is they're saying that even when times are good, it's going to underperform. But it still performs. So if it's performing reasonably well when things are good, and if it's performing reasonably well when things are bad, then you've always got a portfolio that's performing reasonably well. And that's a pretty reasonable thing to do with your money. Like I said, if you want all the upside, you have to take all the downside with it. If this eliminates a large portion of the downside but still gives you plenty of upside, a reasonable amount of upside, how can you go wrong? And you get a great dividend. So the tactical income solution. Let's look at how this breaks down. We've seen this slide a few times, making the cut. Okay? Recession resistant. Recession resistant takes consumer staples and utilities and it adds 4 more sectors to the mix. So tactical income solution as a whole is consumer food, consumer staples, energy, utilities, telecom, and pharmaceuticals. Because no matter what's going on in the economy, people still pay their electric bill, they still pay their cell phone bill, whatever prescription drugs they're taking, they're going to continue to take. You don't cut back on these things in a recession. When the economy is cycling, you're not cutting back on this. Think about what fills up your pantry, your refrigerator, your cabinets at home. Did you buy less of that stuff in 08 and 09? Generally not. You're still going to buy cereal, you're still going to buy paper towels, you're still buying razors and shaving cream, you're still paying your electric bill. Anyone give up their cell phone in 08 and 09? I know some people did, but not most. Okay? Recession resistant. So you already saw the slide where we have a big X drawn through the companies that don't make the cut. Let's talk about the companies that do make the cut. These are just some examples. Campbell's Soup, Waste Management. Talk about a recession-resistant business, the garbage business. More population, more garbage. Great dividend. Recession-resistant, makes the cut. Is that not just a pure and simple common sense investment when it comes to recession-resistant and a dividend? That's what this is all about today, is just giving you those light bulb moments, cut through all the clutter, clarity and confidence to say, look, Waste Management is in the garbage business. There's going to be more garbage year after year after year, which means they're going to keep making money year after year after year. You're not cutting back on your garbage. In fact, more and more municipalities, in an effort to save money, are contracting with more and more companies like Waste Management to outsource their garbage collection to companies like them. How can you go wrong with a company like that in your portfolio for the next 10, 20 years? Pretty neat stuff. So let's talk about a few of these companies. Kimberly-Clark, kind of the stepsister to Procter & Gamble, not nearly as well known as P&G, but a dominant force in the consumer staples area. Kleenex, brand tissues, Pull-Ups, Huggies, Dove, Aleve aspirin, Flintstone vitamins, it's all Kimberly-Clark. Procter & Gamble, everything from Pringles potato chips to Gillette razors to furnace filters to pet filters to Duracell batteries, it's all Procter & Gamble. 3M, everything from Post-it notes, furnace filters, Band-Aids, Scotch tape. My personal favorite is the Scotch-Brite pad, that green and yellow pad. Because when I was growing up, my mom worked part-time and my grandma would watch me and my brother on the days my mom worked. And she always had one of those Scotch-Brite pads up on top of the sink. And she would wear that thing down to the tiniest nub that you could ever possibly keep your fingers on. But when it came time to throw that nub away, what's the next thing she would reach for under the sink? Another one, right? To replace it. No matter what's going on in the economy, she kept buying those Scotch-Brite sponges. Every single month, every trip to the grocery store, she's probably buying them. Waste Management, we already talked about that. Very, very common sense type of company to own in this portfolio. Kraft. Now I recognize that Kraft and Mondelez, there was a split, but I like keeping the slide up here because it really speaks to the brand that is part of that company. You can buy a frozen pizza, DiGiorno, Jack's, Polly-O, or Tombstone, and every one of those you're buying from Kraft. Chips Ahoy, Nabisco, Wheat Thins, Planters Peanuts, Jell-O, Honey Maid graham crackers, all from Kraft. Did you guys cut back on any of these things in 08 and 09? Nope. Fueled by population growth? Yes. It's my favorite slide. We're all familiar with Coca-Cola for the brands that make up the top row. Coke, Diet Coke, caffeine-free Coke, Sprite. But those bottom two lines, most people aren't nearly as familiar with. Did you know Coca-Cola makes Minute Maid orange juice? And all those different power waters that you see behind me? There are 17 different brands of bottled water on that slide. And they're all distributed by Coke. Okay? Now, In the past, there was a seminar I did once where a gentleman raised his hands and said, hey, I heard the mayor out in New York is trying to limit the size of soft drinks. You remember when some of that was going on a year or two ago? Going to limit the size of soft drinks. And this person in the audience that raised his hand right here said, isn't that going to potentially hurt Coca-Cola? And my response is, you have to drink something. If soda or pop was completely eliminated from the marketplace, and all you had was 17 different brands of bottled water to sell, you think Coca-Cola is still going to be okay? Of course. And truthfully, would Coca-Cola rather you buy water or Coke? Because the margins are higher, right? So go ahead and ban Coke from the marketplace. They'll be happy to sell water to fill that gap. Big margins. All right, pretty neat stuff. McDonald's, we talked about this. 27 million Americans eat at McDonald's every day. Every day. That's almost 10% of our population. That's just in the US. Now that doesn't mean they're having a Big Mac extra value meal. They might be getting a cup of coffee or a cheeseburger or a Happy Meal for their kids, whatever. But 27 million a day. Now here's what's even more remarkable about this slide is there's only, and I say that on purpose, there's only 48 million worldwide. Our country in terms of population is very small compared to the world. Look at China and India. Billions and billions and billions and billions of people live out in the world. There's only about 350 million that live in the US. And we have half the consumption of McDonald's. That shows how much upside there is left to grow for McDonald's. I know there's some health-conscious consumers out there that think McDonald's is just going to fade away. Their brand is weakening, but they're smart people. They run a good business. I had a client or a seminar attendee raise their hand once and say that McDonald's is it's unhealthy, it's trending poor, we should not buy McDonald's. They were reading some stuff in the newspaper about McDonald's. And I said, give me the name of a restaurant that you like, one of those healthy, all-natural, health-conscious, socially conscious companies. And she kind of, she didn't really know what to say. I said, how about Chipotle? Right? So I talked about Chipotle, and she was familiar with Chipotle, of course. And I said, did you know Chipotle was actually funded and started by McDonald's? McDonald's had a 40% stake in Chipotle. They have since sold off most of that stake. McDonald's, the brand, isn't going anywhere. But they have an extremely strong balance sheet and some very smart business people that will make sure that they're going to be making money for a long time to come, whether it's McDonald's or Chipotle or some other business they're going to be in. McDonald's is here to stay, and especially globally, tremendous growth opportunity. So I love having McDonald's in the portfolio. Looking at pharmaceuticals, there's Eli Lilly and there's Bristol Myers Squibb. A couple other pharmaceuticals will make the cut here as well. AT&T and Verizon are the two telecom companies that make the cut. They both pay a fantastic dividend. Q-Star is a huge natural gas utility out of Utah. Southern Company, one of our country's largest utilities, 4.4 million customers based out of Atlanta. A fantastic company. No matter what's going on in the economy, people still pay their electric bill. More people, more population means more electric consumption, which means you only make more money from owning these utilities over time. Duke Energy, similar story. They're a little more invested in the alternative energy, wind and solar. Fantastic addition to the portfolio. The tactical income solution is a mix of 65% equities and 35% bonds and cash. Notice that the equities, and we're going to break this allocation down in a more formal way here in a second, but notice that the equities, there's actually 25 different equities, only have a 2, 3, or 4% allocation depending on the equity. It's a small piece of the pie. Why do we divide the equity portion up so small against all these different companies? We do it that way so that no individual company will hurt you. If we wake up tomorrow and McDonald's, for whatever reason, is out of business, it's only 2% of the pie. Not enough to hurt. You'll realize it, but not enough to hurt you. We have a saying that individually, none of these holdings matter. Collectively, they all matter. Because collectively, they're all part of this solution that we're building. Recession resistant, nice dividend, fueled by population growth. Now, I know that all of this is just kind of theory right now. You hear me talking about it, it all sounds good. What I want to do is take a moment to pass out some reports. Please don't flip through these yet. Just put them in front of you. I'm going to walk you through these reports, okay? If anyone needs another one, let me know. One more. You guys okay there? Fantastic. You over here in the corner, here's your report. You're welcome. Okay. This is going to bring everything to life. You see here on the top, Liberty One, which is the investment committee that we have here at the Trinnell Financial Group, says Tactical Income Solution. This is the historical performance of everything you just heard me talk about. What I want you to do is take a look at that front page, and I want you to pay particular attention to the line graph on the right side. When you look at this graph, I want you to realize that the blue part of that graph is the stock market. That's the S&P 500. The red line on that graph is the Tactical Income Solution portfolio over that same period of time. Which line would you rather be on? The red one. Notice the downturn the market did in 2008, 2009. Notice how Tactical Income Solution did not fall nearly as far. And then, as the market started to recover, so did Tactical Income Solution. Look at how much smoother that red line is during the recovery than the choppy blue line. Look right below that graph. You'll see where it says trailing returns. Look at the 3-month, 1-year, 3-year, 5-year, and 10-year. In the last 3 months, your portfolio, this portfolio is up 4.82% in 3 months. The stock market over that same period of time was up 4.93. Look at the upside you had, and you were 35% bonds and cash. You had 1/3 less equity exposure, and you're right in line with the S&P. That's phenomenal. Over the last year, you'll see this portfolio was up 11.35%. The market was up 13.69. Phenomenal, considering you were 35% bonds and cash. Now, this is going to hit home with a topic I brought up earlier in the seminar. Look at the 3-year return. The market has been hotter than hot the last 3 years. And like I told you earlier, this portfolio is not designed to keep pace with a hot market. It's designed, like I said, to give you a reasonable return over a reasonable period of time. Over the last 3 years, this portfolio has averaged 12.86% per year for 3 years. The S&P 500 over that same period of time has averaged 20.4. Like I said, if you want all the upside, you have to accept all the downside. But you've got to give us some credit. 12.86%, is that pretty reasonable? Of course. It's awesome. The 5-year number and the 10-year number are both right in line with each other. Fantastic returns with 1/3 the equity exposure. And the equity exposure you have is all the non-cyclical stuff. There's no finance, no technology, no retail, no industrial. We leave all 4 of those sectors out. Here's the best part. Right under returns, on the right side, you'll see where it says portfolio yield. The yield of this portfolio is a little over 3.5%. The yield of the S&P 500 is about 1.8%. So think about that. About twice the yield of the S&P, roughly, about twice the yield of the S&P, less risk, and a very, very good return. You see where this can fit into your allocation mix as you're thinking about your own personal money and some places you might want to park that money? This is the part of the presentation where, like I kind of said jokingly, I could talk you to sleep on this stuff. I could talk you to sleep on every number in this report. We could talk about beta and standard deviation and alpha and all sorts of jargon, like I mentioned earlier in the seminar. But I just want you to see, I want to bring to life what this allocation can do. Pretty neat stuff. The next step is important. Usually at this point of the seminar, there'd be some hands that come up and say, how do we buy this? What do we have to do? So I put this little slide together to really break down what the next steps are. First thing you need to do is you need to open up a brokerage account with us. Very easy. Just your name, address, phone number. We open up an account for you. Then we need to fund the account. We can do that by investing a check. You just simply write us a check made payable to the brokerage company, or you can transfer current accounts that you have into the new brokerage account. You just transfer them in kind, meaning as is. What you have here gets transferred over here. Once all the assets are there, we convert, meaning we sell the stuff that you transferred over. And after we sell the stuff, we allocate it into the portfolio, and you're off to the races. 3.54% dividend, a great return, recession resistant, population growth, dividend aristocrats, all that stuff we talked about is all of a sudden yours. Very, very easy. So remember, regardless of the state of the economy, people still blink. When you go home tonight, or you wake up tomorrow and make breakfast, think about what you're pulling out of the refrigerator, out of the cabinets, when you're brushing your teeth, the razors, the toothpaste, all that stuff will remind you of this allocation. It is so neat to talk to clients who are in this allocation. They talk about when they go grocery shopping, they are actually looking to find the brands that they know they own, to support their brands. When you own a mutual fund, you don't know what you own, right? Unless you actually read the reports and the prospectus. With this, you know what you own, and you know what you own at your house to support what you own. That's pretty neat. And while you own it, you're going to get a great dividend while you hold it. That dividend keeps coming in like clockwork no matter what. And it's all backed by population growth. Fuels the demand, which fuels revenue, and revenue fuels a higher stock price over time. How can you go wrong over the long run with that? I'm going to break for questions here in a moment, but what I'd like you to do, if you would please, is take out your evaluation form. And like I said in the beginning of this presentation, I want you to write your name, your phone number, and your address down. I want your address no matter what, so we make sure that you stay on this list. I know some of you were invited here through some guests, and I'm hoping that the ones that we don't have your address for, you're willing to give it to us, so we can at least mail you invites to future seminars. Growth and income bucket, estate planning, tax planning, college savings planning, all that stuff. And like I mentioned, write your phone number down if you want me to give you a call so we can set up a time to get together. If you put your phone number down, I will call you. If you don't put your phone number down, I'm not going to call you. It's that simple. But I know even if you have good intentions to meet with me and you don't write your phone number down because you say, I'm going to call him, I don't want him calling me, there's less than a 5% chance we'll ever get together anytime soon. Because life gets busy, you get back into your routine, this all sounds good right now, and then tomorrow you wake up and you're busy again. So at least share your phone number with me so I can give you a call once in a while, keep you in my hopper of people who want to meet with me so we can make some real neat things happen with your money. All right? And then Q&A. So that's that. So usually in Q&A, talk about fees, and they'll have questions about fees that happened today at Wildberry. How much does it cost to get together? All that kind of stuff. So when someone asks, what do you charge? They'll ask it in one of two ways. They might say, what do you charge for the first meeting? And the answer is nothing. We have free consultations. But when someone asks, what do you charge to manage the portfolio? I'll say this. We are fee-based advisors. We're not commission-based. We get paid based on the value of the account. We charge anywhere from 0.5% per year to 2% per year to manage money. We structure it that way so we get paid based on how we do, not commissions to buy and sell. That's a great way to have a relationship. And actually, it's my job, believe it or not, to double your fee. But in order to do that, I need to double your account value because our fees are tied to your account value. And that's basically how you answer that. Okay?